earlier, welcome to the second cohort of Investing for Independence, Basics of Investing in the Stock Market. Just a few housekeeping, and it's only a 2-week course, but again, I just like to share these just in case there's any questions. Every week we try to start on time. I do, give like a minute or two for everyone to join before I start speaking, but since this is only a 2-week course, I'm gonna make it my mission to start no longer than 1 to 2 minutes after the start of class. We will, and please complete every assignment that I send out. They're not difficult, but it will truly help as I'm going through these slides and explaining things. So hopefully everybody got through that 18-minute video, because I am gonna reference it a couple times during tonight. It's a quick video, and I think it's a really easily digestible way to understand the basics of how the market started and what it entails. And so hopefully you also wrote down or typed up the 42 definitions. Again, these are terms and words that every investor should understand, at the basic level. And so I may be throwing some of them out tonight. I'm sure I will. It will just make things a little easier in understanding. If you have questions, I was going to say raise your hand in the participant area, but I don't think I have that. Let me see, do I have that even? Yeah, I don't have that feature turned on. I forgot to turn it on. I'm not going to just ask the question when, I write down your questions. Like I said, we'll take breaks and I'll get to Q&A. And if a question arises after the class is over, after Monday night's class is over, join us on Saturdays. Saturday is really just a recap of everything that I go over today, plus a less formal conversation. And actually last month, the Saturday sessions were real lit, and yeah, I'm looking forward to those as well. You can also post questions in the Facebook group under the corresponding week number. So actually, I may not do, just if you have questions, put them in the Facebook group. You can also email them, but I highly recommend not doing that, just simply because it may take longer, especially if it's a time-sensitive question. So just to go over what to expect and what not to expect really quick, and there's a reason, there's a method. So when I send out, or when I ask you to complete the questionnaire, it's because I want to make sure I'm not wasting your time, and that you truly understand that this is a basics course. This is beginners level 101 course. And, there were some people that responded and they were like advanced level and they wanted some advanced strategies. That's not what these next 2 weeks are about. So it's learning the basics of investing in the stock market in an easily digestible format to become a more knowledgeable and involved investor. You're going to learn the benefits that are associated with long-term investing, and also learn how to decide on or set up a brokerage account to begin your journey as an active investor. If you already have a brokerage account and you're not an active investor, that's great. You'll find out ways to become an active investor. Now, if you already have a brokerage account and you're on there trading and you understand everything about the trading and investing world, this is a waste of your time. And I think it's a waste of your time if you understand. So I just want to level set the expectations for the course and what not to expect. This is not a how to get rich quick course. We understand that wealth is obtained through knowledge and education. And for those who were with me or part of the cohort last month, we understand we're woke investors, and woke just simply stands for wealth obtained through knowledge and education. So this is a marathon, not a sprint. You will not learn how to trade options, Forex futures, or day trade any other high risk strategies during this cohort. And there are no promises or guarantees. And for everyone that knows, we will go over the disclaimer each and every week. And I forgot to share my sound. Hold on, I just want to make sure that sharing sound is on. Okay, perfect. Okay, so tonight's agenda. We'll do orientation, which we're kind of doing now. We'll talk about what compelled me to create the Investing for Independence movement. We'll talk about why you decided to join the movement through the questionnaire that was answered. We'll go over the weekly topic review. We'll talk about the stock market and exchanges from a basic level 101. We'll talk about banks versus brokerage firms. And then we'll have Q&A, a dedicated time for Q&A. So let's quickly talk about what led to Investing for Independence. On January 8th of this year, if you follow me or if we're connected on Facebook, a lot of you know that for years I post about the stock market. And a lot of times I would get hit up on the side. And some of what I posted was frustration from the articles that would come out on how we are just so not represented in this space and how we need to be, because truly this is where the wealthy people live. This is where people who live a independent/free life get to do so. They have their money working for them versus them working so hard for their money. And as an investor, well, let me just read my vision, my commitment. So my goal for this year is to help at least 200 new underrepresented investors get into the market. Why, you may ask? And I had posted an article about how we, unfortunately, with the complete run that the market had in 2020, Black people and people of color were less than, I think, 5% or were able to benefit. Only 5% of us were able to benefit from that run, where, unfortunately, our counterparts were 90% of who, was able to benefit. So that articles like that come out every so often, and it infuriates me. And instead of me just getting mad and posting like little posts about you should be in the market, this is why you should be in the market, what I realized is a lot of people just didn't even understand the market or understand how to get into the market. So I also know that from my perspective, as it relates to people that I hold near and dear, I mostly only gift equities over toys or cash now. So because I know the benefits of it, I know the long-term benefits and how we will ultimately pass on generational wealth by doing that, especially for the younger generation. It also explains the reason why, I often post about the market, and simply put, I want to inspire my people to invest. I've been thinking of ways to put more action behind my posts, and this story, which was the story I just referenced on how we did not, unfortunately, take advantage, or we were not part of the wealth that was created in 2020, it made me realize that the time is now. My motivation to be of service is on 1,000. So beginning the first week of February, and in honor of Black History Month, I'm going to be the change that I want to see in the world by sharing the basics of investing in the stock market. I'm going to talk about terminology, goals and plannings, the process of opening and funding a brokerage account and buying stocks. I purchased my first individual stock over 23 years ago and haven't looked back. If you are not invested in the stock market, or if you have an account, but it's dormant and you want to make it make sense, please send me a message with your email address and I will message dates and log in information as soon as possible. FYI, it doesn't take a lot to get started. 500 invested in Tesla stock on January 2nd of 2020 would have been worth $4,741 today. And that was as of January 8th, 2021. And you can see the list goes down. $500 in Apple, Netflix, and Tesla would have yielded you substantial returns. Whereas if you just put $500 in your savings account, a year later, it would have only been worth $505, which technically is no money, because once you pay taxes on that, and as we laughed about, if you have to spend gas to get to your bank, you're in the negative. And so, I love the quote where Beyonce says, "Pay me in equity, watch me reverse out of debt," because the rich people understand that cash is a liability. It's not an asset, but you give me equity, I understand that that's going to grow for me. So Anyway, these were some of the shocking headlines, and I'm going to send out the links to this call to everyone who's on this call. And anyone that just joined, please put your name in the chat just so I know that you're here. But I'm going to send it out to everyone on the mailing list. So if you didn't respond to the mailing list in some way you're on this call, definitely put your name in the chat so I can make sure you get this. All of these are linkable to the articles that are referenced, but here are some of the just shocking, make you want to gasp headlines. African-American wealth may fall to zero by 2053. I don't know. I don't know, but I be damned. Not on my watch, as they say. We definitely have to change that trajectory. Some reports say we'll be negative by 2053. And once you're negative, you're totally expendable, basically. And so we need to change that trajectory. Stocks are soaring, and most Black people are missing out. That was the article I think that I posted with the Facebook post. Black Americans are less likely to invest than white Americans. Black families average less than 15% of the wealth of white families, according to the Feds. And then there's a Pew Research study that will be attached as well that gives you more insight into how we are lagging behind. But before I go any further, this is a must. This is a disclaimer that anyone who really tries to educate people on the market has to, let me just read the whole thing. Investing in the stock market involves financial risk, and it is not suitable for everyone. Invest at your own risk. I am not a financial advisor or fiduciary. Any content that I share is for informational purposes only and based on my own personal observations. You should not construe any such information and or ideas as financial advice, and always, and I repeat, always do your own research. Should you have specific questions regarding taxes, please contact a certified public accountant and or tax professional. And so that is just to let you know, I have taken no legal oath. I have taken no legal oath to act as a financial advisor. And I want everyone, even though that disclaimer can seem somewhat intimidating, it's just really a protection. Yes, there are financial risks. I have been in the stock market since I said 23 years ago, and I would do it all over again, and I would invest more all over again. So that's just to let you know there are risks. Who knows what can happen in the future as far as anything is involved, this particular company, anything, chemical warfare, anything. But it's just to let you know that there are risks, but I highly, 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 highly believe this is the best way to attain wealth. So I just want you to listen to this quick 27-second audio. If you can't hear it, let me know. I turned on the sound, so hopefully, and let me turn up the volume. Hopefully you can, but here we go.
I realized they had saved up money to move here, almost the same amount as I had saved up, right? Right. They had done that working in factories. They had worked menial labor jobs. Me? I moved here, I cashed in stocks I got from my bat mitzvah. I mean, who is more hardworking, So
were you guys able to hear that? Just a couple people answer.
Yes, that was good.
Okay, perfect. And so
yes.
Before I move on and before I share my thoughts, I am going to stop sharing really quick because I want someone to share with me what did they think about what she said. What's the first thing that came to your mind? Okay, I see the cottons.
So it's funny, we have a 2-year-old, and when I grew up, I didn't have bat mitzvahs. I didn't have people putting money towards our future or anything like that. So Ty and I, all we're thinking about is not even how we're going to live. It's how Maya is going to live. So I look at her like, I want Maya to be able to have that same statement. What can we do now that's going to put her in that position? Because we're already behind the curve, just as a people. So I'm really thankful. I'm here for this. So
excellent. And this was just on Bill Maher, Real Time with Bill Maher Friday that just passed, and I was like, I mean, the signs are all around. But anyone else want to share? Did it speak to anyone else? I need one more person to share something.
Basically, she was saying that my take on it, she was saying that, hey, I know that hardworking people deserve more than I do when I'm just like getting stuff from bar mitzvahs and stuff. So, you know, that kind of thing. She's putting it out there that, quote unquote, I'm privileged. That's my story and I'm sticking to it.
Yeah, and that's absolutely. But she also gave us the blueprint.
Absolutely.
Right. Seconds. That's the blueprint right there. So you have something to say?
I feel like she was saying that, you know, that I was able to obtain these things and not really work hard. She didn't have to work hard for it.
All she had to do was call her broker.
That's right.
Out how much equity
Absolutely.
And the fact that she had gotten this, you know, I don't know when she did it, but she got it at an early age.
I think Bob Mitzvah was like 15 or something.
Something like that, right?
Yeah.
So,
she knew.
But I'm saying I don't know when she cashed it in.
Oh, okay. Yeah.
You know, but that money was growing, compounding for her all that time. And all she had to do was call her broker.
Exactly. And just to give a little bit more insight about her, because you brought that up, she got that at her bar mitzvah, which I believe is 15. She moved to Los Angeles in 19. She was talking about moving to Los Angeles. And there's more insight. If we have time at the end, I'll tell more about Annabelle's story. But she moved to California in 1989, which is when she started cashing it out. So and she's 59 years old. So from the time she was 15 to 1989, which I can't do the math real quick, but it's quite a few decades, a couple decades, she was able to basically survive and not like the vets, or I think it was Sonia, you said not really have to work.
Right.
So the blueprint is there, and it's just unfortunate that, you know, just like I said in the last cohort, they didn't want us to read because they wanted to hold us back. They don't want us to know about this, right, which is why trigonometry in high school instead of investing in the stock market. And so, this is it's critical, it's urgent, and any questions before? Also, bar
mitzvahs are at 13. And so I was kind of, when she was speaking, because I when I was teaching, they invited me, it was twins. And I didn't know that just that young, that they can read that and understood it at 13. Yeah. You know, so that's something like that's something also to think about. I didn't know.
Yeah, I don't know if she knew or understood, but the adults in her life knew and understood and gifted her these stocks because they knew it would appreciate versus giving her, here's $1,000 in cash or whatever the amount.
That's true.
And I know, Dominique, you should have corrected me.
I was just about to say, I was about to jump in right before Yolanda and say, I was going to bar mitzvahs. I went from public school to private school, and bar mitzvahs were the first. Well, that was my first experience with like wealth and just knowing that there's another way to live. Mm-hmm. And I was at these bar mitzvahs, and I remember my mom was like, you have to pick a couple to go to this year because you have to buy a dress. You got to give it. They're getting checks for thousands of dollars. And that was my first experience being like, oh yeah, this is different. And to your point, like, I don't think that they even knew how it would affect their futures, but that was just normal for them. Like that was normal. And that was my first like eye-opening experience about how they, other people live.
So this is, like I said, a blueprint for you guys in 27 seconds. And it's not only for, children, this can work for adults too. So like I said, this was, if she did this in 1989, she's 59. I'm going to say, let's just say it was 15, 25 years, somewhere around there. A lot of us still have 15, 25 years to watch our, income grow exponentially. Exactly. And we're not even talking 15, 25 years. Technically, long-term investing is technically defined as 366 days. I personally define it as 5 years, especially the way the market is, nowadays. But anyway, so let me get back to the presentation so I could kind of get through this, but that's definitely a video that just spoke to me, and I was hoping that it would speak to you guys as well, and it will be in your in the link that I sent to you. So Brother Ice Cube, you know, he came under a lot of flack earlier, well, the end of last year, but of everything he was saying during that time, this quote right here truly, truly, truly made the most sense to me. And I honestly could not have, I guess, put it any better. Basically what he was saying is, I don't care who the president is. I really only care about Black Americans getting capital and equity, because we're not even part of the game. Which he's really saying is, we're not even part of the thought process, the conversation, because we don't have capital and equity. But we think we're part of it, and we demand all this stuff, and we pretend to be because we demand all this stuff, but you're not even part of the game in a capitalistic society without no money. But you're not even part of the game in a capitalistic society without no money. A capitalistic society simply means money. And if you are negative, as we are heading the trajectory we're heading towards or heading down towards, we're going to be a non-factor if we don't change this. And so, yeah, that's part of my mission and part of the reason why I'm doing this. And so I'm not going to play this video until the end because I want to get through this, but it is here. And it's basically Kobe talking. Someone on CNBC asked the great Black Mamba when his legacy, when it was time to talk about him and his legacy, would he want to be remembered for basketball or investing? And without thinking, he immediately said investing. And that's because he talked about, you know, there'll always be a new basketball championship. There'll always be a new MVP. But as far as investing, you create legacy. You leave legacy, you create wealth, and you influence the generations behind you. And that to me is powerful. Again, this link will be part of your, if we don't get to it, it'll be part of the Zoom link that I sent to you. And so this is a just easy to read chart. You know, men lie, women lie, people lie, numbers don't lie. And basically, this speaks volumes. In 2019, the average wealth of a white family was $184,000. Mm-hmm. The average wealth of a Black family makes me want to cry. $23,000. And we're headed in the wrong direction. While their numbers are going up, our numbers are going down. And so, again, I'm preaching right now, but I really want you to understand the importance of this. And I don't want you just to take these two courses or these two classes, these 2 weeks, and walk away from it. I want you to execute on it. And then I want you to tell people. I'm doing this every month, actually, hopefully for the remainder of the year, because again, I want to hit that goal. I want to hit that target of 200 people. And then next year, I want to 10x that. I want it to be 2,000 people. Like, I just want these numbers to change. We can do this in a generation if we try. And let's just look at asset allocation by race. So whites held slightly more than 100 trillion in assets at the end of the first quarter of 2020. And it breaks down everything from real estate to consumer durables, to equities, which are stocks, to pensions, to private businesses and other assets. If you look at the total bar under whites, you'll see that represents 100 trillion. You can also easily see the blue part of the chart for only, well, you can kind of see it with other, but you can't even make out a blue, the blue part of the chart for Black and Hispanic. And that's sad. You know, it's because the stock market is truly for everyone. And we'll get to basically how we all can take part in the stock market. But this is another chart that just literally brings me to tears and then infuriates me at the same time. And simply, like I said, they didn't want us to read. They don't want us to be great. There's a lot of lies. There's a lot of little things they put out there to make us scared of the market. Like you have to be rich to invest in the stock market. Fake news. I'm going to lose all my money if I invest in the stock market. Not if you're a woke investor, not if you educate yourself, because you're making smart moves. Now, if you don't know what you're doing, yeah, is that a possibility? Absolutely. And nothing is guaranteed. Like I said, I can't promise that, there won't be a nuclear attack. God willing, it won't. But I'm just saying, short of any catastrophe, if you educate yourself, then the chances of you losing all your money in the market are slim to none. It is too risky. Not if you educate yourself. You need to have good credit to get a brokerage account. That's another fake misnomer out there. And even if you have what was I gonna say? If you have bad credit or whatever, this investing in the stock market is an amazing way to pay down your debt and get out of debt and increase your credit score. But yeah, these are just lies, and you won't be able to access your money if needed. Another fake news story. Most of these brokerage accounts now act as banks where you can get your checks associated to those accounts. You can have all your weekly paychecks or biweekly or however often you get paid deposited into your brokerage account. You have debit cards against your brokerage account, and you can get credit cards. Like most brokerage accounts are best in class brokerage accounts. You can do the same things you could do at a bank while getting a higher rate of return on your money. And we can simply change the direction. And I just want to shout out my graduates from the February cohort, because again, they have done it. And actually some of these numbers should be updated. But as of the end of the course, as of the last day of the class, we had 28 new accounts that were created, brokerage accounts, and 7 dormant accounts that were activated. There were people who didn't even, they went to open an account at a certain brokerage and found out they had an account there from an old 401k, from an old job that they had that was literally generating no wealth. Like there was no activity on it. And so, and some people also got their children custodial accounts and brokerage accounts. So weekly topic review. Week 1, most of you guys should have read this. I know all of you should have gotten it. Week 1, we'll do the orientation, stock market, and stock exchanges, why I invest, ways to invest, and brokerage options 101. Each Saturday, if you miss Monday's class or need a refresher or have questions, join us on Saturday. Next week, we'll talk about investment plans and strategies 101, which is the basic lifeblood of you investing. We'll talk more about brokerage firm options and deciding what to buy and or sell using the beginner's toolkit. And we'll also have some more insights shared along the way, but that's pretty much the overview, the weekly overview for the next 2 weeks. What is your understanding of the stock market, which was one of the questions that was asked, and all you guys that are here answered. And I just want to give you a little breakdown. So about 3% said they know a lot, but the 3%, I would challenge them any day to the definition of a lot, because the stock market is a beast, but they felt they were kind of comfortable in that space. 40% said they know a little, and 57% said this is all new, which is the information that I need, like I said, to make sure that the information that I'm sharing is in line with what your knowledge base is. And do you have a brokerage account? 49% said yes, 51% said no. And, the number this month was slightly higher or much higher than last month, because we do have some return students who have since opened brokerage accounts. And I'm not going to go too harsh on the Robinhood users right this second, but anyone who was in last month's course knows that it's coming, and it'll be coming later on today. And truth be told, if you have a Robinhood account, I'm just going to say you really don't have a brokerage account, and you'll understand why in a few minutes. And then I just listed some of the responses for what you want to get out of the course, and how to track and research companies, go back to basics, so that I start trading with a plan instead of listening to tips, but better understanding of the stock market terms and landscape, the do's and don'ts, how to read charts. We're not getting into that, which is why it's options trading. And I don't believe he's in this class because I did share that that's not what this is about. But learn basics and feel comfortable to get started buying, selling stocks. And you'll have this, like I said, in your link. And I also send out the slides. So you'll have all of this to reference later. So just a little bit about me for the people who don't know me, and who the heck am I, and who am I to be talking about some stock market anything. All right, here we go. And, my name is Kim Smith. I am first and foremost a lover of Christ. I'm a Christian unapologetically. I'm an entrepreneur. I'm a long-term investor, but I'm also a swing trader and an options trader. I do trade for income. I've invested a lot of money to be able to do that. So I don't like day trading, but if there's a great opportunity, I do day trade. And for those of you that don't know, swing trading just simply means trading that takes place 2 or more days under a year. So day trading, you in and out of trade that same day. Swing trading, you buy something today, I may sell it tomorrow, sell something today, buy it tomorrow, because that's called shorting, excuse me. So, and I could also buy something today and hold it for 3 months and get out of it. So I know how to read charts, and that's a little bit about my trading, or what I do on a investing and trading side. More about me: I graduated from Howard University. My first job before going to Howard was at a brokerage firm called Thompson and McKinnon. And I worked for he was like the president of the firm, but he was called something manager. And he was like 29 years old, multi-millionaire, who tried to convince me not to go to college because he thought it'd be a waste of time. He told me I could train under him and become a millionaire within a year or two. And I kindly said no. He offered me, at that time, this was many, many years ago, he offered me like $60,000. I said no. He came back with $100,000 offer. I didn't even tell my parents because, well, my mother would have still said no. My dad may have been like, oh, you ain't going nowhere. You gonna stay here and make that $100,000. So I didn't even tell my parents. I went off to college. And that was the last I really had involvement in active brokerage firm trading experience. But I did also work at Commodities Futures Trading Commission during college. After graduation, and then for the majority of the next 30 years, I spent as a media sales exec. 17 years of those was at Essence Communications, also known as Essence Magazine, Essence Festival, Essence.com. I worked with a lot of big banks, helping them craft a communications message towards Black women. And I learned a lot about their thinking and thought process about this audience and how they really devalue and undervalue us. And then in 2018, I launched Truth Hall LLC, which is a multicultural consulting business where I work with a lot of my multicultural clients to, again, teach them how to speak to Black people. And then in 2017, one of my biggest passions is traveling. And that's another area where we were fed a lot of lies. And so I created Black Travel Culture to educate our community on not only the benefits of exposing ourselves to other countries and other cultures, but also how easy and affordable it is to do so. But in 2020, it all got put on hiatus due to the pandemic. But again, I'm not new to this. I'm true to this. I've been for my people. I will always be for my people. Everything I do must have a social empowerment component to it. Just some images from Black Travel Talks, which is a live event that I put together in 2019 to bring executives and influencers and journalists and content creators to speak to the masses about the world of travel. It was also one of my biggest proudest moments was being featured in the Howard Woman magazine. I also teach young college students about the value of this market, Black and African American. One of my biggest icons is the late, the great John Lewis, Honorable John Lewis, who was a freedom fighter, who truly, was willing to give his life for us. And I just, you know, when I talk about making the ancestors proud, he's definitely one that I hope to make proud. And also, you know, my girl Kamala Harris, a fellow Howard alum who I represent, I go hard for. Okay, so let's just debunk some of the myths, the main myth about investing. And this is coming straight from the dawn of the investment world, the long-term investment world. If you don't know who Warren Buffett is, please Google him, please research him, but he is pretty much the man that knows it all as it relates to long-term investing. And what he says that I think is just so beautiful and so simple, but most of us don't learn until later. You don't need to be a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. It's really not. The stock market is really for those who are willing to put in a little bit of time to learn exactly how you can make the market work for you. It's the woke strategy. It's the woke investor mindset. So education is, according to Nelson Mandela, Madiba, who I also hope to make proud, education is the most powerful weapon which you can use to change the world. Period, exclamation point, point blank. Understand and implement the woke investor mindset. Wealth is obtained through knowledge and education. You're going to hear me say this a gazillion times during the next 2 weeks, because it's true. The more you learn, the more you will earn. You cannot just go in there willy-nilly thinking you're going to be the most successful. Will you have some success? Absolutely. You could go ahead, go invest $100 in Nike, and in a year, more than likely that $100 will have generated a lot more return than just putting it in the bank. But that's not wealth creation. So you want to learn how to create wealth. And it started with the 42 woke terms. Now, 42 was my little play on Black History Month, because truth be told, I probably could have gave you 142 to start with. But, you know, to really get the conversation going at the basic level, these are key 42 terms that every investor should know and understand in order to be a successful investor. So hopefully, once again, you wrote those down. I'm a writer. That's how I learn. Some people like to type, but I just hope you look those up. And I gave you the reference Investopedia to go and search those words. And anyway, so sorry, I have this toolbar that I have to move out the way so I could read, so forgive me. What is the stock market? If you watch the video, most of you should be able to answer that question, but I'm not going to put you on the spot right this second. The stock market is also known as Wall Street. Excuse me, I'm actually going to go to the next slide. Yeah, let's just go to the next slide because it's already 8:14. You'll have the breakdown definition of stock market, like I said in the slides that I sent, but stock market versus exchanges. The stock market represents the companies that list equity shares for public investors to buy and sell. You know what? This is beginner, so we're just gonna have to take some time. Let me just go back to this one, sorry. The stock market, also known as the stock exchange. Now, some people interchange those, but the stock market and exchange are sorry, my battery was about to die. We'll get to the differences. So the stock market and equities market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuance of shares of publicly held companies take place. Such financial activities are conducted through institutionalized formal exchanges or over-the-counter marketplaces, which operate under a defined set of regulations. There can be multiple stock trading venues in a country or a region which allow transactions in stocks and other forms of securities. If one says that he or she trades in the stock market, it means that he or she buys and sells shares and equities on one or more of the stock exchanges that are part of the overall stock market. The leading stock exchange in the US include the New York Stock Exchange, that's also NYC, NASDAQ, and the Chicago Board Options Exchange, CBOE. These leading national exchanges, along with several other exchanges operating in the country, form the US stock market. So that is the detailed breakdown. Again, it's a summary of what you will remember from that 18-minute video. And then again, here's how they are different, but yet connected. So the stock market represents the companies that list equity shares for public investors to buy and sell. The stock exchanges are the actual infrastructure that facilitate the trading of those said equities and or stocks. Without a stock exchange, companies would have no formal mechanism on which to list shares. And without a stock market, exchanges would have no reason to exist. So they're separate, but one cannot live without the other. Stock exchanges can be electronic or manual, and they provide telling information about the size of the stock market. So again, if you saw the video, hopefully this should make sense. But to break it down just a little bit more, think of any type of market. This is actually the French market in New Orleans, one of my favorite places. And if you think of each booth representing a company, where buyers, that would be like me, and sellers, that would be the person that owns the booth, come to an agreement on a price of a particular item. In the stock market, it would be a stock, and we complete a sale or transaction. That means I hand over tender to the booth owner, or in the stock market, I actually buy and or sell buy a stock to own it and sell a stock to get rid of it. So that's basically the ABC version. Now I am going to stop sharing real quick because I got a question. And if you were in the class last month, I don't want you answering, but does anybody, oh, let me go back to the screen, sorry. Does anybody, just tell me, just yell it out. Does anybody know who this girl with the braids is?
Was it Jill?
Jill.
Yes, who was the first person that said that?
I was. I'm gonna take that. It was me.
Okay, who was it?
Warimo. Or Remy, it was me.
Okay, and then who was the second person? It was a male's voice.
I was. Darren.
Oh, okay. Okay, so y'all two, y'all get extra credit. I'm writing your names down, but yes, that is Jill. And can I just tell you, I love me some Jill, and everybody from last month knows that I know and love Jill. So let's go to the next slide. I had to write your names down, sorry. And this is why I love Jill. Because Jill went from getting her feelings hurt. She had a beautiful lemonade stand, and she needed money to grow this business. She had a lot of customers, but in order to keep up with demand, she needed, you know, to hire more people, to buy more inventory. So she goes to the bank and she's like, listen, bank, I got this great lemonade stand. It's making a whole bunch of money, but I need a loan from you guys so I can grow and keep up with the demand. And the bank was like, yeah, Jill, you two knew we don't trust you. They could have even been like, you black, you got braids in your hair, we don't trust you. We don't know why they said no, but they said no. But Jill, she wasn't going to let no stop her. Jill decided to raise her own capital by taking her company from being just Jill's lemonade stand, where she controlled 100% of the company. She took it to the open market and took it public and had people buy shares of Jill's lemonade stand. So she was able to raise capital and enough capital so she could go into the expansion phase. So now instead of just, you know, having enough to be able to afford to just make lemonade and sell lemonade, she knows her lemonade is so good. And then in the summertime when it's 100 degrees and people are looking, you know, for something to cool off, that, you know what, Jill's lemonade popsicles are going to be a hit. But she wouldn't have been able to buy those popsicle sticks. She wouldn't have been able to buy the freezers if she did not take her company public. So that's called innovation and expansion. And Jill, that's my girl. Jill innovated and expanded. So let's just go quickly through the basics of the IPO outside of what Jill did. An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. Companies must meet, excuse me, I gotta move this thing again. Companies must meet requirements by exchanges and the Securities and Exchange Commission, also known as the SEC, to hold an initial public offering, also known as the IPO. There are exceptions, the SPAC and the DPO, which we'll talk about in a second, to those rules. IPOs provide companies with an opportunity to obtain capital by offering shares through the primary market. Companies hire investment banks to market, gauge demand, set the IPO price and the date, and more. So like Morgan Stanley, you could think of as a investment bank who handles a lot of new issuance of IPO companies and IPOs. What's in it for the company? The company wants to raise capital or money to expand their business. They're unable to secure bank loans for the amount needed. Companies find an institution to underwrite a public offering to sell shares of the company. Each share sold generates money for the company, and investors known as shareholders own a piece of that company. And what's in it for the shareholder? Shareholders possess the right to share in a company's profitability and gains from its stock price appreciation. So when a stock price goes up, your money also goes up. Stockholders may also share in a company's profits by receiving cash or stock payments from the company, also called dividends. Now, this is getting far and fewer between, but a lot of the larger companies, old school companies, and even so not larger and old school, but the larger companies with a lot of revenue and the old school companies that have always given out dividends still do that, tend to do that most times on a quarterly basis. You'll get, if you own a share, so like I own Apple, just as an example, every quarter for every share that I own, they give you 18 cents. Or no, it was 20, I think it went up the last month to 22 cents or something like that. So that's called a dividend. And if you own a whole lot of shares, like Warren Buffett, who owns a lot of shares of Apple, I believe, and his dividend checks are in the multi-millions, that's a good way to generate revenue too. Shareholders can also influence a company's management by voting to elect the board of directors, who also appoint the CEO. If a company issues new shares to the public, which they often do to generate more money, current shareholders have the right to buy shares before they're offered to the new shareholders. So you'll get an advance notice, an advance warning that these shares are coming out to the public. Do you want to own them? And then a lot of times you get in at the price before it skyrockets. And I just always like to, this is my favorite case study for a very successful, extremely successful, one of the most successful IPOs ever created. So everyone's heard of Amazon. Well, Amazon held its initial public offering on the NASDAQ on May 15th in 1997 at a price of $18 per share. Whew. I didn't get in then, but I got in a long time ago, but $18, that's just beautiful, considering that it's over $3,000 a share now. So notably, $10,000 invested on that day at that price would be worth than $12 million as of May 20th, 2020. So if you put simple $10,000 that a lot of people have sitting in a bank account right now, getting no interest, or in a 401k, getting, smaller interest. If you would have put $10,000, you would have had 12 million as of May 20th, and it would be worth more today. That would have been more than 120,000% growth. The company's growth has been geometric since its early days as an online bookseller to a juggernaut of a business that sells everything from books to groceries and data storage to movies. So if anyone follows Amazon, we know that Jeff Bezos just stepped down as the CEO, but he is the chairman. But just look at the companies. They went from, when I got in, they literally only sold online books. Now they own Whole Foods, they own Zappos, Ring, We have a Ring service. I believe Ring is one of the biggest security services out there, if not the biggest. PillPack, Twitch, Kiva Systems. The list goes on and on. Alexa, IMDb. Those were all of the acquisitions. There were other Amazon Robotics. Like there were other acquisitions. Some have not done as well as, you know, the ones that are currently listed, but that's what happens. You acquire things, they don't work out, you get rid of them. But if you look at Jeff, even though Jeff Bezos left Amazon, he now runs Bezos Expeditions, which is a whole nother set of forward-thinking companies, which he will probably grow into successful businesses as well. And here are just some of the recent IPOs that were listed. You have DoorDash, Airbnb, Poshmark, Fubo TV, Albertson, and these are IPOs, not DPOs or SPACs. And if you look at the bottom of the slide, there are exceptions to IPOs such as SPACs. What just came out as a SPAC last week? It was Bumble. I think it was Bumble, the dating site. And a SPAC just are rich people raising a whole bunch of money to bring a company to the market, and they don't have to go through the SEC rules and regulations, which also makes them riskier because they don't have to follow the guidelines. So, and the direct public offering is the same. They don't have to follow the same guidelines. So we quickly talked about the New York Stock Exchange and the NASDAQ, but one of the key things I want you to take away from this slide when people say how risky the stock market is, the New York Stock Exchange, as you could remember from the video, was created in 1792, not 1972. Established in 1792. So the odds of anything happening to the New York Stock Exchange to cause a massive, well, there's, you know, all my money is gone, are literally in our lifetime, you know, pretty much non-existent. And the New York Stock Exchange houses more traditional companies such as like Coca-Cola, you know, the companies that have been around for a very long time and started on the New York Stock Exchange, whereas the NASDAQ is more technology focused. And they're all electronic trades. So the New York Stock Exchange, they still have traders who you could call, and they'll call down to the, you know, pitmaster or whoever and say, oh, buy me 2 million shares of this, blah, blah, blah. Whereas every trade that takes place on the NASDAQ is done electronically. And again, most of the companies, even if they don't look it to you, have a technology focus. So, think of, you know, Apple's on the NASDAQ. There was one that I wanted to call out that would not be, it'll come to me and I can't think of it right now. But even looking at when the NASDAQ was created, it was created in 1971. And that, if you think about it, that's when the whole technology conversation really started taking off or making sense. So the technology, when you think about the old style computers or whatever, it was the early 70s. And so I think you guys would know this, but looking at what Jill was doing, which exchange would she be on? Someone just yell it out.
New York Stock Exchange.
Okay, I saw Jackie, Antoinette, and some other people. If I didn't call your name, please, y'all, there was like 4 people. Okay, all right. And so quickly, let's just go through what the indexes are. In the United States, there's really 3 indexes that you'll hear over and over and over again, and they're the first 3 indexes that you'll see on this slide, and they measure how the overall stock market is performing. In total, there's about 5,000 US indexes, but the ones that really are the market movers, as they call them, are the S&P 500, which tracks 500 of the largest companies on both the New York Stock Exchange and the NASDAQ. the Dow Jones Industrial Average, which tracks the stock performance of 30 large companies listed on the New York Exchange and NASDAQ, and the NASDAQ Composite. It tracks over 2,500 securities listed in the NASDAQ exchange. It's also the youngster of the major stock index, and it's viewed as an indicator of the newer sectors of the economy. And just a little tidbit, each and every one of those three have just reached a new all-time high within the past week. So these, all of the market, and when, let's say the market, not the economy, the market is doing well. There's also the Russell the Russell indexes, but the most popular is the Russell 2000, which tracks US small cap stocks. No, not the major stocks. Those are the ones, and we'll get into big cap, small cap, large cap next week. But small cap stocks just have a smaller total value than the larger mid cap and large cap stocks. And it's made up of the bottom, excuse me, let me read this again. The Russell 2000 tracks US small cap stocks and is made up of the bottom 2,000 stocks in the Russell 3000 index. So the Russell 3000 is another index, but usually when you listen to CNBC and they say the Russell is up or down, Russell 2000, that's what they're tracking. So before I go into why I invest in the stock market and the benefits of investing in the stock market, are there any questions? Okay, so this is in no ranking order, but kind of sort it is. The first one is truly the magic of compound interest, and we'll get into that. And it is purely magical and can literally change your life if you invest right. Uninvested cash will lose its value. So you get paid today, that due to inflation and other things that happen in the economy, that $100 today may be worth, $92 by the end of the year. Ownership of a company. I personally like to have ownership in in companies that I use and frequent often. So I gave an example. Let's just say you are a traveler and you are an investor in Marriott hotels. You go to a Marriott hotel and somebody treats you some type of way that is not in line with how you think you should be treated, mention to management, ask for management, mention to management that you are a shareholder, you are an investor. And these are the type of things that we have to get comfortable saying, because this is how the other half lives. And just watch the difference. They don't have to know you own 2 shares or 5 shares or 1 share or 20 shares. But once they hear that you're an investor or that you are a shareholder, you get treated different. They treat you different. They value shareholders. And truth be told, it's the independence for me. My goal is to live a frolicking lifestyle. And frolicking does not necessarily mean just being willy-dilly, but it's to have the freedom to go and come when and wherever, however I choose to be able to offer free classes all day, every day to my people so they can do the same and not have to worry about how I'm getting paid. So, yeah, that's also why we are investing for independence. And this is another quote that you'll get a link to. Actually, it's also in the slides, but it's from, moving this thing again, Gabriela Berospi, who's the founder of the Latino Wall Street movement, which provides financial education to the Latino community. She also provides in-language financial education to the Latino community because they're also underrepresented. And she has an article that recently appeared in Forbes last month, and it just, again, spoke to me. And I'm going to quickly read it as soon as I move this down. Okay. Some of the most successful professionals, entrepreneurs, and influencers go years and years without realizing the power and potential of stock market investing. When it comes to the stock market, there is a misconception that if you aren't provided with special insider education, you will never be able to master it. For that reason, Too many people are missing out on the opportunities that the opportunity stock market investing provides. But as I can attest, and this is Gabriella speaking, the stock market is for everyone. It doesn't matter if you are a student, a young professional, or a retired person. You only need one thing to get started investing and earning money in the stock market: the ability to decide once and for all that you are going to make it work. You're not going to sit on the sidelines anymore. You're going to make it work. And I want you to really take away, it doesn't matter if you're a student, a young professional, or a retired person. Everyone wants their money to work for them. So don't think it's too early or it's too late to invest in the stock market, because it's not. It's really not. So let's talk about my favorite thing, which is compound interest and growth. Compound interest is the addition.
Can I say one thing, Kim?
Sure.
This is Michelle. I just want to ask, but you have to have money in order to invest money, right? You have to have money. You know, you're saying that, you know, that it's easy. You can be a student or whatever, but you still got to have money.
Do you have a bank account?
I mean, yeah, not with much in it. I'm a person that lives from check to check. I mean, you know, it is what it is.
Well, Michelle, if you have a bank account, you can have a brokerage account. I think what the point that's being missed here is that the money that you have sitting in the bank account in your bank account right now is not making money.
Right. I understand that. I do understand that. I do understand that. So go ahead, finish. I don't want to hold nobody up. So go ahead, finish. We'll talk about it.
Okay. So you do have money. So that's all I'm trying to say.
I really don't. No, I really don't. I don't have money to actually, you know, to like $10,000 or $5,000 to put, you know, to invest.
Did you see the first slide that if you invested $500 in January 2020?
Yeah, I did see that. Mm-hmm.
Okay, so I'm not saying 10,000, 5,000. I started out saying $500.
You did.
And cut that in half. So if you would have did 250, you would have had 2,000 and change, 2,500 and change.
So you're saying it's just a one-time deal? Don't you have to still invest every month? Don't you have to pay something? Don't you have to, you know?
You could invest every month. You could invest when I say invest, every time you get, and you know what, we are going to get into this. So you know what, stick around. We're going to get into this. Okay. So I know listen, if I could blink my eyes and make everybody have 10,000 to just sit, you know, I would, but that's not what this is about. This is really about making your money work for you, grow more exponentially so that you could live off of your interest. You could live off of the money that your money is making for you. So anyway, compound interest is the addition of interest to the principal sum of a loan or deposit. Let me read that again. Compound interest is the addition of interest to the principal sum of a loan or deposit. Right now we're talking deposits, not talking loans. Principal investments plus capital gains, dividends, or in other words, interest on interest. So the second paragraph should make much more sense. It is the result of reinvesting your gains, the money that you made from your money or interest, rather than paying it out, so that the interest in the next period is then earned on the principal sum of plus the previous, I'm moving this thing around, previously accumulated interest. Now, if that doesn't make sense, I got another slide for you. Here you go. And I like this one because it's basic ABC if you never discussed this before. Why does compound interest matter? Compound interest equals interest earned on money that was previously earned as interest. So not only are you making interest on the money that you put in, you're making money on the interest that money earned each and every time you're paid out interest. So it's not just a one time I get interest this week or this month. Every time the interest is compounded. So if it's annually, if it's monthly in the stock market, it's, usually, I believe it's monthly. You're getting interest on top of your interest, on top of your principal each and every time. This, the second, where the dollar signs are, compound interest causes interest and account balances to grow. Now, it's good for savings and investments, but it's bad if you're paying interest on a loan. So that's not what we're talking about, because it compounds the same way. So you don't do like credit cards and stuff like that. You don't want compound interest on your loans, but on your investments, it's magic. So the frequency, the time, the interest rate, deposits, and the starting amount all make compound interest powerful. So while your money may not grow on trees, which I grew up hearing from my mama frequently, as you can see, it's out there growing. And let's just take a look at an example. If you would have been around in 1926, or your ancestors were able to invest $1 in the stock market in 1926, based on what they invested in, it would be worth between $7,300 and $37,000 in 2016, excuse me. So let me repeat that. $1 invested in 1926 would be worth between $7,300 and $37,000 in 2016. And most investors back then were investing way more than $1. So even if it was $100, times that by 100. And you want to see how that was possible? If you look at this chart, this is a compound annual return. The green line, the bottom green line right here, is simply inflation. So if you would have invested that $1 and just rode inflation up, it would be worth $21 in 2016. If you would have invested in government bonds, which are low interest bearing investments, that $1 in 2016 would have been worth $143. If you would have invested in large cap companies, which are those big companies that are worth, what is it, $10 billion or more, I believe. It would be, that $1 would have been worth the $7,353. But if you would have invested that $1 in small cap growth stocks, it would be worth $36,929, say $37,000. That's the magic of compound interest. And so how there, when you break down ways to begin your investment journey, and I know some people said in their answers they do have a stock, they do have a brokerage account. I don't know how advanced you are in the brokerage account, how much you're investing, but first and foremost, woke investors, smart investors, wise investors have to learn the stocks and funds that they're investing in. You also have to decide on your involvement. Are you going to be an active investor? Or are you going to be a passive investor? You also have to choose a broker and the type of broker for investing, where you're going to invest your money. You also have to set a budget and a plan. And we'll talk more about that as well. Ultimately, you have to fund the account and select the equities. What stocks are you going to invest in? What funds are you going to invest in? And you also have to focus on the long term. Time in the market always beats trying to time the market. So again, long term is technically defined as 366 days. I tend to go no less than 3 to 5 years. And we talked about what type of investor you're going to be. It's okay. It's okay if you leave, these next 2 weeks and you're like, listen, ain't nobody got time to be researching those stocks, because you have to do your homework. This is all about a woke strategy. That's fine. you can still be a passive investor. And even the Don Dada says it's okay to be a passive investor. He famously said a low-cost S&P 500 index fund is the best investment most Americans can make. And choosing individual stocks only if you believe in the company's potential for long-term growth. And the only way you'll believe in a company's potential is if you do the research. You have to do the work. You have to understand the company. You have to understand their history so you could project their future. You have to understand their portfolio of assets. You have to understand how they're innovating and going to stay competitive. But if that's not your thing, that is okay. I still, and so would Uncle Warren, prefer for you to be a passive investor so that you can make your money grow much faster than it would if it was in a standard bank account. And here's a quick graph just to show you what he's talking about. And I got to move this thing again, sorry. So if you look at the S&P 500 from January 1928 to July 2019, you can see. Okay, so the early years, there was very little movement, right? It's a new format of investing. But once you get around the 70s, you see the growth starting to happen. And it has been pretty much on an upward growth with some corrections, some crashes. But again, we just reached all-time record highs. And I don't know if you can see my blue thing, but we are like up here now. And this is 2021. So again, a investment in a low cost index fund that tracks the S&P 500 is better than not investing in the market at all. I prefer active investing if you really want to, look at the wealth gain from a real lens. But again, I don't knock passive investors at all. And maybe some of your investment is passive and some is active. But again, so we also talked about, understanding your stocks. And this is going to be part of your homework for this week coming up to Monday. And one way for you to understand your stock is to create a watch list. And the watch list helps you plan. A watch list, what is that? For those who don't know, a watch list is a customizable list of stocks that you want to keep an eye on, preferably a diverse list. So you don't want all technology stocks. You don't want all energy stocks. You don't want all industrial stocks. Like, you want to have a variety. And it's a central part, a watch list is an essential part of planning your investments. They let you quickly see whether specific parameters have been hit, and consequently, whether it's a good time to buy or sell your assets. Watch lists must be part of any woke investor's strategy. Now, my favorite way to create a watch list for beginning investors is simply picking stocks that you like, companies that you like, I should say. You want to not even, and this is going to be the homework assignment, so I'm letting it kind of, one of the parts of the homework assignment. You're going to pick 20 companies. 20 companies that you really, really like, that that you like either shopping at the stores, you like buying the merchandise, you like using their products, and write them down along with the stock price. But don't let the stock price guide you. Like, just write down your favorite stocks, and we'll get more into that. I don't want to take up too much time there, but that's going to be part of generating your investment strategy before you start investing. And a watch list, like I said, is part of the knowledge and education part of learning how to invest or investing smart. So
Kim,
who's that?
this is Betty.
Oh, hey, Betty.
Hi. So I call a brokerage firm, right? I open up an account.
Mm-hmm. Congratulations. Go ahead.
No, I haven't done it.
Oh, I thought you said
this is a scenario.
Oh, got it. Okay.
And I will talk to you one-on-one about where I am with that, because I think I need to have a conversation with you. But
okay.
You call up, you open the account, you say you have $500. that you want to invest, right?
Mm-mm. That's not the only way to do that. That's not the way I would do that, but go ahead.
So that's what I'm trying to understand. Like, what does that conversation sound like once you start talking with the broker? Because let's say I do have $500, I want to invest. There's 3 companies that I'm interested in. Who decides how that money is distributed? Like, how does that work? Like, if it would be helpful if, I mean, you don't have to do it tonight, but to understand, like, once you pick up the phone, you call the broker, you open up the account, what does that look like moving forward? Like a standard scenario.
Okay. And so, because I know you were in the class last month, and that was addressed, and I can definitely direct you to exactly, because we're not talking about picking up the phone and calling a broker. You don't have to do that. The best in class brokers that went over, you could do all that online.
Correct.
Right. You don't have to immediately fund the account, but if you do have money to fund the account, absolutely fund the account. And then you make your trades when you're ready to make your trade. You don't have to speak to a broker, nor do I.
See, okay. I guess I'm not clear about, you open it, well, why wouldn't you go ahead and start putting money in it? What are you getting?
Some people aren't ready. They're still researching. They're still doing things. So it's like, that's why I said, if you have the money, absolutely. But everybody's not starting at the same place. So this particular course is to meet people where they are. So that's why I said, if you have the money to invest, absolutely put the money in. And as I mentioned last month, and I don't want to give away what I'm about to go into for the new people, but yeah, so let's have a side conversation, Betty. Let's do that.
I need to be in that conversation too.
Yeah,
I understand what you're saying, Betty, and it's not clear to me, Kim. It's not.
Well, and Michelle actually asked the question that I had on my mind, which was, do you make a one-time, can you make a one-time investment and then, watch your money grow? Or is it smarter for you to continue to add money to that amount over time?
So again, that goes into the investment plan we went over in the last class. So it all depends upon everyone's plan, right? And it all depends upon everyone's budget, and not everybody's the same. So we're getting ahead of the new course right now. So
Okay.
So and again, I do these Saturday regroups where we can ask any questions, so I don't want anyone to think that you can't come in on Saturday or at the end of, I won't say this class, we can't, well, let me get through this, because I'm sorry, there are people on here that are literally beginners. So let's look at the various asset classes to invest in the stock market. We talked about the stocks, like you can buy shares of a company and you become an owner in a company. Well, there's also ETFs, which are also called exchange traded funds. Now, they kind of look like a mutual fund. So let's talk about a mutual fund first before I go into the definition. So a mutual fund is an investment strategy that allows you to pool your money together with other investors to purchase a collection of stocks, bonds, or securities. So mutual funds are managed. Like you're not necessarily going to be able to say, I want Apple, I want Nike, I want this and that. You have to find a fund that meets the same criteria of growth for you as a stock would. So if you're looking to, grow your money at minimum 10% a year, you have to do the research, which we'll get more into. You have to do the same type of research for that mutual fund. So when it comes to ETFs, the ETF is a hybrid of a stock and a mutual fund, whereas it looks like a mutual fund because it's a conglomerate of stocks together, but it trades like a stock. So you can buy shares. You can literally trade. I could buy a certain ETF, and I'm gonna give one ETF that I invest in. It's called ARKK. ARKK owns Tesla, owns quite a few high value tech stocks, and I could buy ARKK today. I could sell it tomorrow. I could buy it this morning. I could sell it before market closes. I could buy it today. I could sell it 10 years from now. So that's the difference with ETFs. Mutual funds, you can't do that. Mutual funds, you can't trade on a short-term basis. Mutual funds, you buy, you hold, you let it bake, as they say, and then you could come in and out. Some are monthly, some are every 6 months. It depends on the mutual fund. So those are the different classes. Then there's also cryptocurrency, but we're not really going to get into that in detail because that's not part of the beginner strategy. It's too volatile. It's too volatile of an investment right now. So I don't feel comfortable sharing much about cryptocurrency. Even though I invest in cryptocurrency, I understand that my numbers can drop in half in a day. So I just don't highly, I don't want to share that with the beginners. So equity funds, okay, so we talked about exchange traded funds, ETFs, which are a hybrid of stocks and mutual funds. Here's the way, there's different types of ETFs. So you can have equity, which are stocks, like I said, they're like Apple, Tesla, Netflix, whatever. You can have fixed income funds, which are mutual funds that own fixed securities, such as U.S. Treasuries, corporate bonds, and municipal bonds. So those tend to have lower risk, but also lower reward. Also commodities, which are metals, gold, silver, energy, oil, gas, agriculture, which could be wheat, hay, all of that stuff. Currency, you can also invest in currency funds, which track foreign currency as well as cryptocurrency. But again, it's the fund, it's not the actual currency. So you're not buying Bitcoin, you're buying a fund that they track Bitcoin, Ethereum, and some other cryptocurrencies. You also have real estate funds, which track real estate, big real estate companies. So it's a fund made up of real estate companies. And then there's also specialty funds, which you can leverage and bet that the market can go down and make money that way too. Oh, and this is blurry. I'm sorry about this, y'all. But again, this basically is a repeat of a visual, which will be in your deck that I send out of the types of ETFs that we just repeated. And then here are examples of certain ETFs. So one that I mentioned, I told you I own ARKK, but QQQ tracks the NASDAQ. So it'll track the top 100 companies in the NASDAQ. And you could buy funds to literally track the NASDAQ. The same with SPY, which tracks, excuse me, which tracks the S&P 500. And I forgot how many companies are in there, but it's a conglomerate of companies that you could buy and trade. Again, I said, these are the ETFs, so you could trade them, you buy them today, you see your profits went up. Maybe you had an objective that you want this to deliver 30% return. And once it does, you're going to take your money and use that to pay down debt or whatever. That's fine. You could come in and out of ETFs just like you can a stock. And we talked about
Excuse me, Kim, I have a question. I missed what you said. Which one tracks the S&P 500? Which one?
Oh, SPY, but there's a few, but SPY is one of the bigger ones for ETF, SPY.
Okay, thank you.
And then we talked about diversification. Excuse me. Diversification is important because it spreads your investments around. When one investment goes down, another might go up and balance things out. And so what you'll see in the market, and we'll go through this next week with a live example, but what you'll see in the market is when you have a portfolio and it's, let's say you have, I'm just going to, for sake of math, let's say you have 3 stocks. One is a tech stock, one is a energy stock. No, I don't like energy, sorry. One is consumer discretionary stock. So like you're talking like Walmart, Amazon, whatever. And one is healthcare. The market can have rotations where certain sectors may perform well, and anyone who's been following the market the past month or so, technology has been kind of lagging, where financials has been taking off because of the talk of interest rates. But that's okay. You're not getting rid of your technology because you're still getting that compound interest even when the stock goes down. But if you have a nice, robust or diversified portfolio, now financials is taking off and your numbers are growing exponentially. And then when the rotation happens, you'll still ultimately make money. You're not putting all your eggs in one basket. And so this image just kind of shows, like, you can have all tomatoes, you can have all greens, you can have all pumpkins, but the images to the right of the screen, you want eggplant, you want cherries, you want tomatoes, you want some greens, you want a robust portfolio so that you're not putting, all your risk in one area. And the same, it's nice to have a big piece of salmon, but that lettuce with that tomato and that balsamic vinegar and those avocados, that's going to make, a nice healthy meal. And so when we get into the homework for next week, this is kind of what you're going to do. And I'm not going to go through it right now because it's 9:02. So what's that? It's an hour and a half. And I want to get through these next few slides really quick. So we talked about diversification. You want a car, you want some clothes, you want a house, you want technology. You don't just want to live in a car. You don't just want to live in your clothes. Like you want to think about it from like basic terms. But what's important and what we are talking about, and hopefully this will answer one or two questions. I don't think it'll answer all based on the questions that I heard, but let's review your brokerage accounts. Brokerage accounts versus banks. The main difference between brokerage accounts and banks, brokerage accounts allow you to trade and or not trade, or let me say invest and trade in the stock market. Bank accounts don't. Bank accounts literally take your money that you invest with them, and they invest your money with a broker and a stock and buy and sell stock to generate interest to make money. That's how banks make money. They make money off of your money. Whereas with a brokerage account, you have the ability to make money off of your money. And the type of money that you're going to make is based on the type of investments you choose to make. So if you want riskier investments, you invest in riskier stocks, and we'll go over high risk versus low risk stocks later. But that's pretty much the basics of a bank and a brokerage account. Like I said earlier, brokerage accounts, you can now do the same things you do at a bank. You could get loans, you can get credit cards, you can get checks and write, all your bills against your brokerage accounts. You could set up your brokerage account into a high yielding type of savings account, although I don't recommend this, but while your money's sitting before you invest, you can get guaranteed interest rate that's higher than what the banks are offering you. And when you're ready to invest that money into stocks, ETFs, options, whatever you're investing in the market, then that's when you would take the money out and make those investments. But again, you have a lot more control and a lot more flexibility at a brokerage account. And we're going to quickly talk about the discount broker account versus a full service broker. Discount brokers are able to offer most of the services and functionality of a full service broker at a much lower price. Investors who like choosing their own stock and funds can save a fortune by using an online discount broker. And we'll go over discount brokers because those are the ones that I talk about for beginning investors. Full service brokers are great if you're wealthy, super wealthy, and you don't mind paying exorbitant fees for other people to make these same transactions for you. And so let's just quickly read what that is. FSB, full service brokers, are related to, like the stockbrokers of yesteryear. So back in the day, everybody had to call up a broker and ask them to make a transaction. And you could pay anywhere from, $100 to more, $150, I heard at one time, for them to, you call, I want 20 shares of this, you got to pay them $150 to make that trade for you. Whereas discount brokers, there's no fee for most of the best-in-class discount brokers. So full-service brokers often employ human brokers only who can help you make the trade. Now, discount brokers also have human employees, and quite a few people that I know who have opened accounts. After they opened their accounts or before they opened their accounts and they had questions before opening, they called. Yeah, you may have to wait because everybody's trading nowadays. So you may have to wait, 30 minutes to 45, 50 minutes to speak to somebody, but you do have the opportunity to speak to a licensed broker to get your questions answered. Now, if he makes that trade for you, if you want him to just do what you can do and buy certain stocks, he's going to charge you to do that. And the charges vary at the discount broker level from broker to broker. So right now, a full service broker charges a minimum of $75 to place a trade. And it can jump as high to $500 or more if you buy a large amount of stocks. So I don't think that applies to anybody here, but in the future it will. And that's why wealthy people use it, because they tend to often not want to, they're on the beach or they're on the golf course and they're making these big trades and they don't care about that little $500 that they're paying a broker. It's not necessary for people who don't fit that category. Buying a mutual fund through a full service broker can potentially set you back thousands of dollars, since they often charge fees equal to a portion of the amount you invest. Full service brokers are more likely to have higher account minimums. So listen, the full service brokers may very well decline your business if you come in there with $500. It's just what it is. They're in the business to make money. They tend to cater to high net worth individuals. But if you have a few thousand, they may take your money. And I literally mean take your money, because you're not going to get the same attention as a high net worth individual. So full service, some advisors only work with clients who have 1 million in assets or more. That's not everybody. More and more, they're lowering those numbers. But again, you have to have 500 is not going to cut it. So realistically, the lines between the two types of brokers are slowly starting to converge. Discount brokers now have wealth management services that offer the help of a human advisor at a full service price. So that's basically where I have my brokerage accounts. They're all at, except for one, but it's a 401k that I don't touch and I don't touch, meaning I don't make the trades. I have somebody else doing that, but that's simply because I'm comfortable with my returns. It's part of my investment strategy. So some full service brokers also offer a basic level of service at discount prices, such as Merrill Edge. So let's just go into what the best-in-class discount brokers are. Best-in-class discount brokers, and this is not Kim Smith ranking them, this is ranked by the most notable, reputable financial institutions, and there's a reason why. So Fidelity has a online discount broker, E-Trade, Charles Schwab, TD Ameritrade, Interactive Brokers, and Merrill Edge. Charles Schwab just bought out last year TD Ameritrade, so by the end of this year, it will just be Charles Schwab. It may be Charles Schwab Ameritrade. I don't know what the final name is going to be, but again, they're best-in-class brokers. And you may ultimately see more mergers in the future as, the financial industry merges anyway, similar to how the airlines are going to merge. But again, these are the best in class. And why are they the best in class? And we'll go over why in a second. But one of the main reasons, and I believe it's the next slide, yes, most of them, all of them, are tied to one of the top 10 US banks in the country. And if you look at how much these banks are valued at, JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, Goldman Sachs, PNC Financial, Charles Schwab, are all in the top 10 to this day. And which means your money is heavily secured. You're not worrying about the bank going under. You're not worrying about somebody running off with your money. Your bank is heavily secured, and each and every one of the best-in-class brokers that I just showed are attached or owned by or partnered with one of these top 10 US banks. And so, as I said, we're going to talk quickly about, well, I don't know how quick it is because I want my point to be heard, but Robinhood is not best in class, y'all. Not best in class by any stretch of the imagination. I know it's easy breezy. I know they accept everybody and anybody who, wants to invest. But word on the street and the reputable financial street is that Robinhood is stealing from the poor and giving to the super rich. And you may ask why. Well, let's just go over some of the things that are known about Robinhood. And this is not everything. This is just some of the things that makes my stomach turn, because they are targeting, if you watch their commercials, a lot of them have people of color in it. If you, it's a lot of things that are wrong with Robinhood. So let's just go one by one. They have limited equity. So they don't have the full robust list of stocks that you can buy. I think total there's 250,000 tickers in the US stock market. They have a fraction of that. They have an extremely limited watch list feature. That watch lists are very important when you're talking about generating wealth. When you're talking about, I'm not talking about hitting a lick. I'm not talking about, getting in on GameStop and it miraculously goes up to 600 and drops back down to 20. Like, I'm not talking about that. I'm talking about long-term investment. You want to have a watch list and you want that to be the main part of your strategy. And Robinhood has a limited watch list of features to create and track your watch list. You want services and protection when it comes to your money. Robinhood simply does not offer those. There have been multiple outages in the past year costing investors millions, and there are multiple lawsuits. And you know what Robinhood's answer was to people who were affected? We're going to give you $75 for your trouble. If I can't make a trade and you cost me thousands of dollars, what would make you think that I'm okay with $75? Hell, if I couldn't make a trade and you cost me $75, why would an equal $75 because of your error be a satisfactory resolve? And it shouldn't be. And you should not be at a broker that has multiple outages. You want, now, not saying Fidelity's never had an outage or TD's never had an outage, but Robinhood is notorious for their outages. And some people think that they're on purpose, but I don't know. Robinhood provides a bare bone trading experience, making it a poor choice for investors seeking the best trading platform. Also, Robinhood stock research tools are severely lacking when compared to zero fee brokers such as TD Ameritrade, Charles Schwab, and Fidelity. Now, this next one just pisses me off because no other financial institution that I've ever heard of falls in this category, but this is directly from Robinhood's website. We don't currently allow users to name a beneficiary. We don't offer automatic transfer on death registration. In the event of death, we will work with the executor of the estate to collect proper documentation and dissolve the account appropriately. Now, anyone that's on this call that has any type of financials, or rather it's a 401k, rather it's a bank account, every financial institution allows you to name a beneficiary. Like, that is just basically, they want to make it hard for you. God forbid something happens to you or your loved one. They want to hold on to your money. They want to make money off of your money, but they don't want to give you your money. Like, that to me should be illegal, but it's not. Robinhood customer support is notoriously bad. Users complain of waiting weeks, underscore weeks, for an answer in the app's help section. lengthy queues to speak to someone on the phone, no response to emails, and a general lack of urgency in responding to important issues. That speaks for itself. But let's really talk about how Robinhood makes money. They sell your information. That's how they make money. Instead of searching for the best price for a given stock for you, Robinhood is instead selling your data to a high-frequency trading firm, also known as a HFT, for massive profit. The HFT firm adds the data to their algorithms to better understand the flow of retail money. And FYI, your money's retail money. You're a retail investor. The only types of investors is big banks and retail investors. We fall under the category of retail investors, i.e. retail money. So they're taking your data, this HFT that Robinhood is working with, to figure out your flow of money. And you want to know why they're doing that? Well, basically, HFT is the real customer for Robinhood. It's not you. They don't care about you. They care about these HFTs. These companies receive order flow from Robinhood. They're getting the best payment of all, information on the trades that will happen. In other words, with this information in hand, these companies can place trades of their own ahead of Robinhood's users, also known as front runners. So basically, and we had an example in last month's class, there was a gentleman, I don't know if he's on the call now, but he literally placed a trade in the morning where he was up. He was thinking he was cashing in on a great trade. By the time they executed his trade, he was $5,000 in the hole. $5,000 negative from thinking he was trading positive. So forget the fact that you can't name a beneficiary. Who wants to be at a broker that can't execute a real-time trade? And when I say execute a real-time trade, simply that means if I see a stock that's at $100 right now, and I place the trade saying I want to buy that stock at $100, your trade should go through as soon as you place that trade. That's called executing a trade. And that was part of the vocabulary words as well. But your trade should go through. However, Robinhood holds they sell your information to the HFT. The HFT then holds they take all that information and see what moves are about to be made. So then they can say, oh, shoot, everybody's buying AMC. So let me buy 1,000 shares of AMC first. Then I'll put their shares in, make the price run up. Then I'll come out and make the price drop. Like, it's just so much wrong with Robinhood that a lot of people are unaware of or blind to, and they're targeting people because they know people are not using the woke strategy in these stock market streets. They just come in and buying and selling and not knowing what's going on. College students or anyone over 18 can sign up for Robinhood accounts and get into options market without really understanding what they're doing. I'm an options trader. I love options trading, but options trading takes time to learn. People should not be out here trading options if they don't know what they're doing. It's a quick way, not a quick way, high reward, but super high risk. And they're letting 18-year-olds go in and trade options with no equity. And I don't know if you heard about the gentleman in Florida who killed himself because he thought it showed on his account, I think he was $700,000 in the hole. He didn't have $700,000. He was like 22 years old. He didn't want to bring shame and disgrace to his family. So he killed himself. And his parents actually have a lawsuit that was just announced last month against Robinhood. And they charge you for what other brokers give you for free, like their research tools and market data. If you have a funded account at any of the best-in-class brokerage accounts, and I don't mean thousands of dollars, if you have a funded account at any one of these brokers accounts, you can get all access to their research, you can get access to their market data, and some of them, you don't even have to fund the account. You can just access the information for creating an account, which is why I recommend, even if you don't have the funds right now, but you want to start this wealth journey, after you do your research to see what best-in-class brokerage firm is for you, see which one offers you free research and insights. So while you're looking to make that shift or trade, fund that account, you can do some research. You could create a watch list. You can research the stocks that you're interested in. And then finally, where's their YouTube page? Every credible financial institution has a YouTube page to help people understand more about the investing and trading process. Nope, not Robinhood. So as I said, and as I said in the last class, if you decide after you hear all of this information, you're a Robinhood user and you're going to stick with Robinhood, fine. That's on you. I just want to make sure you're aware and what can happen. And I don't want it to ever come back and say, you know, I heard in Investing for Independence, we should go to discount brokers. Yes, that is absolutely true. And I listed the 6 that I highly, highly believe in. And I'm listing the one that I think they're crooks. And as you can see, the government's also, I don't know if you've been watching, whoever has it, but whoever has Robinhood, but the government is all up and through them with what they did, halting trading for certain stocks. People could not get out of stocks when they ran up, but yet the brokers can get out of these stocks. These HFTs can get out of these stocks. So they're robbing from the poor and truly, truly giving to the rich. That's my story, and I'm sticking to it. Okay. Next, questions to ask your broker. So, and when I say questions to ask your broker, again, you'll see through the next slides, you really don't have to call because their information's on the website to find, you know, to see if what they offer. But these are the top questions you should have answered before you decide if the broker fits your needs. What are your fees? So, you know, there could be various fees at various brokers for whatever it is you need to do. Most all brokers, well, all of the brokers that I listed as best in class do not charge fees for buying and selling stock. But some may charge you if you want to get a paper statement and you have less than a certain amount in the account, they may charge you for that, but they won't charge you for an online statement. You want to know what research tools are available. Can I search stocks? Can I, and we'll go through that in a second. So do you have a practice or simulator platform? Meaning, can I practice with paper money, fake money, to see what, you know, I'm thinking about investing, or let's see if I would have invested $1,000 in 2019 in this particular stock, how much it would be worth. You want, like some people want to have access to that. So you want to know if a particular broker offers that. Is your execution in real time or delayed? So the best in class, what I showed you, they're all real time. Robinhood, as I shared, can be delayed. And I've heard many stories of them being delayed. Is there a customer service phone number that you can get to? All of the best in class that I listed to you, they all have live numbers. You can call, like I said, based on a lot of people transferring out of Robinhood to these best in class. And there's, I think, 2 people on the call right now who's personally told me that the people they spoke to had said, we're getting a whole bunch of calls from Robinhood people and we've been overwhelmed and inundated. So y'all making it a little bad for the people who have been invested with these companies. And if I just need to call and get a quick question answered, I can't even get through for like 45 minutes to an hour. What is the settlement time for your money? So if you make a trade, usually there's like, if I sell a stock, it could take 3 to 4 days for my money to settle in the account. But you want to know what that is. I mean, for me, that's not, I don't care about that. But for new investors, you want to know, like, is it going to take me 3 days before I can make another trade? Or, you know, how does that work? And how long does it take to access funds if I need it? So do you have checks? Do you have debit cards? And again, the next slides will break that down as well. What platforms are offered? You know, maybe you don't have a desktop and you want to use the web or mobile features, and you want to know that they're stable. Again, the ones that I listed, all of the best in class fit the bill of having stable platforms across all platforms. And can you designate a beneficiary? Once again, all of the best in class allow you to designate a beneficiary to your account. And here are the types of accounts. You have, in a brokerage account, you have standard, also known as traditional, which is simply, you know, where you buy, sell stocks, mutual funds, bonds, or exchange traded funds that we talked about. And you pay, you know, regular taxes on that, meaning, and we'll talk more about taxes next week. You have retirement accounts, traditional IRAs or Roth IRAs. And that's different, some are delayed tax and some are tax-free. They grow tax-free, and that you'll see that on the next slide. You also have educational accounts, which that's all I give now really to my younger family members. And we'll talk about those. And those are either to pay for educational expenses, or you can gift it to an adult when they're between 18 and 21, depending on the type of account. No, excuse me, the educational account you have to use for education. I'm sorry. And then the custodial account, which is the next one, you can, it's controlled by an adult, but it's a good way. If you open one for your child or a child, you can introduce them to the stock market and let them pick the stocks. Like I said, my best approach for picking stocks or selecting stocks is buying companies that you like, buying companies that you want to own, buying companies that are strong as well. And there's someone sent me this link about these kids who talked about their wealth journey and their teenagers. And they started with Nike and I want to say Apple or Microsoft or something, but it was companies that they use on the regular and they like, and it didn't take a whole bunch of research, but they knew their balance sheet, the company had enough money that it wasn't going under. They were strong companies, they were big companies, but they were companies that they liked. So did you know? So a lot of people don't know this, and it's a beautiful secret for anyone who's interested in saving for retirement. Retirement accounts offer you tax-deferred growth of your investments. But if you have a Roth 401k or IRA, or Roth IRA, you get tax-free growth. Meaning, let me just break this down. If you are, let's just say 50 years old, you start a Roth IRA and you put over the years, I don't know, let's say $10,000. And depending on your investment strategy, that $10,000 grows to $100,000. When you go to take that money out, you pay taxes on none of that. Because the Roth IRA went in post-tax, you have already paid taxes on that money. Any and everything that you accumulate in that account is now also tax-free. So this is a game that they truly don't want us to know, because if you start this in your 20s, and let's just say every pay period, you're putting $100 into this Roth IRA and you're making smart investment choices, by the time you turn 59 and a half, 60, whatever, when you're about to take out that money, and that 100 a year is now how many ever millions, you don't pay taxes on that money. Like it's the most beautiful thing in the world if you are planning for retirement. But let's talk about custodial accounts. So custodial accounts, there's two that you can look at. Well, there's actually, outside of the education one, the 529, there's the UTMA and the UGMA. And these are accounts allow you more versatility so that you don't have to use the money for educational purposes. We all know that every child is not going to go to college or go to higher education. There may be some artists that, are dancers that decide to travel the world being a dancer. There may be, brilliant minds that don't need to go to college. Maybe they're just totally, getting into this artificial intelligence world or this robotic world. And you create this 529B college fund. And if you don't use it for college, it goes to waste. The only thing you can do is transfer it to somebody else who's going to college. So I'm not saying that I'm against the 529B or the 529 plan, but the UTMA and UGMA gives you more versatility. And so it's something to look into if you're looking for custodial accounts. Okay, and these are the final slides coming up. And this is just, again, and I'm going to send you a link where all of this could be found at a glance pretty much on a page. But like I said, things that matter is using the woke investor mindset. You want to look up, when you research brokers, you want to find things that matter to you. And so the only thing that's missing from here is Charles Schwab, and that's because TD Ameritrade is here, and pretty much TD Ameritrade's platform is being said is going to transfer over to Charles Schwab because they have the better platform for do-it-yourself brokerage trading and investing. So if you look at TD Ameritrade, Fidelity, Interactive Brokers, E-Trade, and Merrill Edge, you'll see the key features for beginners. Education, you can look up stocks. What I would recommend you do, wherever you see a red X, let's see which broker that is and see if this applies to you. So you can't do education or mutual funds at Interactive Brokers. So if that's important to you, then that's not a brokerage house that you want to select. Education or retirement, which I think is key for most of us. Interactive Brokers doesn't offer that, but every other broker does. Paper trading, everyone does except Fidelity and Merrill Edge. So if practicing with fake money so you could get a real life look at what could potentially happen, if that's important. I know it's important for me, and I'm an investor and I still paper trade just so I know how stocks move. So again, videos, if you want to look up videos to see, research webinars, TD Ameritrade has over 500 free webinars that you can access. And so the list just goes on. And then if you go to other things that matter, banking options that we talked about. So you look to see who has a retail location, who's a member of FDIC. But even if you're not a member of FDIC, that's fine. There's another, oh my gosh, it's something like FDIC, which, all of these best in class, your money is protected up to $250,000 per account. So let's just say, God forbid, not for bad investments, but let's just say, God forbid, the company has to file bankruptcy, right? Lehman Brothers had to do it, not saying this will never happen again. Each one of your accounts is protected up to $250,000. And then, for the most part, they try to make good, if that happens, they will definitely try to make good, but it is guaranteed up to $250,000. All of them have checking accounts. Everyone except TD Ameritrade and Interactive Brokers have savings accounts, credit cards, debit cards, mortgage loans, and no fee banking. So it depends upon, again, what your areas of interest are. Again, stock research, you could look at this at your own time, but these are things that matter. Research overview, if you want to, again, not for beginners, but if you want to do research at a more advanced level, this is the grid that will share. And it looks like all of the best in class offer all of the research opportunities for investors. And then it tells you what type of investments you can do. So if you're into fractional shares, last month I didn't really speak out because I don't buy fractional shares. It's not part of my strategy. I like to own outright, like I like to own full shares. But I do believe that fractional shares are better than not investing at all into good companies. I just don't want people to buy fractional shares. My fear is that people will be so worried about buying the hot stocks that they will overlook some really good stocks that are on a growth trajectory that you could buy whole shares of instead of trying to buy a fractional share of Tesla or a fractional share of Google or a fractional share of Amazon. So again, if fractional shares is where you if you want that to be part of your investment strategy, then you search to see what brokerage companies offer that. And I'm not against fractional shares. Again, if you're more advanced, you may want to look at the pink sheets of a company. If you want to do options trading, later down, you want to see they all offer options trading. Futures, Forex, crypto trading, none of them offer right now. That may or may not change in the near future. And again, it tells you how many mutual funds they offer, if there are fees, and the ones with no fees, the ones with some fees. So yeah, this is definitely information that you can access easily online. And again, I'm going to send you the link. And then you want to see if there's fees, what type of fees they have for closing accounts. And this is the recommendation that I have for Robinhood brokers. If you do have Robinhood, and after hearing everything Auntie Kim has just said, and you decide that, you know what, I'm gonna think twice about this Robinhood situation, and I'm gonna look into somebody else that may offer me at least the opportunity to list a beneficiary. If you decide to transfer out of Robinhood, because I know there were a few of you that have Robinhood, it's not a difficult process. If you pick one of these best-in-class companies, I can't speak on Interactive Broker because I have no knowledge of them, but it does say they don't have a transfer out. But most of the other brokers will cover your transfer out fee from any other broker that you transfer into. So it's not just Robinhood. If you're at another broker and you're like, you know what, I was at E-Trade, but I'm looking at TD Ameritrade and they got 5,000 of free hours. I may want to transfer out of E-Trade into TD Ameritrade. TD Ameritrade will cover the cost, which is $75 according to this grid. Once you fund your account, TD Ameritrade will cover the $75. They will put the $75 in your account that that E-Trade took out of your account. So another good reason to be at a best-in-class broker. Also, trading fees. There's no real trading fees for stocks, and there's no minimum deposits for any of these accounts. So that's why I'm saying, like, so even if you start off small and you're doing, you know, whatever small is to you, because small is relative, right? So if you start out small, that's fine. You know, that's absolutely fine. And there's no fees if you have smaller accounts. And then mutual funds fees, I don't know. Again, mutual fund is not what I'm really focused on. You can, before I selected a mutual fund, I would definitely speak to somebody, you know, because mutual funds have hidden fees that you may not be aware of. And my mutual funds are handled in my 401k by someone who understands the mutual fund games, because mutual funds can be really tricky. And so, again, mobile platform capabilities, you want to know, you know, based on your needs, can this particular brokerage house, you know, fulfill those needs? And so that pretty much wraps up week one. I just really want to thank you. Actually, let me just go through next week's agenda real quick. Saturday, let's start with the assignment you will receive tomorrow. Excuse me, overnight tonight or tomorrow for this week coming up, the next week coming up, which are due by the next class, which is Monday. Saturday at 6 p.m. is the recap Q&A session. And again, next week we will review investment strategies for growth, value, and dividend stocks. We will review investment plans and planning, because you always have to know your whys before you buy. With anything, you should know your why. So again, if you're going to buy, you know, Apple stock, you need to know, and you'll notice I reference Apple a lot because I love Apple. Even though Amazon's my favorite, but Apple is my second favorite. I think Apple's going to be my favorite. But anyway, you want to know your whys before you buy, meaning you want to research the company and make sure they can deliver or whatever your goals are. And we got to get that mindset right. And we'll hear from Uncle Warren Buffett next week again about, you know, not everyone's built for this market, but they can be. They can be if you educate yourself. It's all about the education. It's all about being and staying woke. And then we'll continue with questions about brokerage accounts. And so this is my weekly. Let me see if it'll work this time. It probably won't, but I always do my closing bell. Ding, 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 ding. Thank you very much for coming this week. Looks like everybody pretty much stayed the whole class. I'm very happy because this was a long one. And so, back to Q&A. So I'm going to stop sharing screen.